Jon, thank you very much for joining us today. Before we get into the details, could you just tell us a little bit more about your background and experience in the world of investment management?
Thanks, Emily. Yes. I was born here in Jersey and was lucky enough to start my career at a fund of hedge funds here, which was a great opportunity to build amazing exposure from early in my career to begin meeting and learning from some of the best investors in the world, really, as we selected these and used them to construct multi-asset portfolios. I had the opportunity to move to New York with my career in 2009 and spent 10 years there, working right in the heart of where the majority of hedge funds are based. So at one time or another, I covered almost every major strategy group, equity strategies of all kinds, commodities, systematic trading strategies, global macro. It was a great education.
So it must have been quite an experience.
Yeah, it was an amazing experience being, right in the thick of it, and just a great education in the huge variety of ways in which people can approach investing. How to source ideas, how to develop conviction, how to construct portfolios, and how to manage risk.
And obviously, if you're in the industry, you've got a fairly good idea of what you're doing. But for a lot of other people, it is quite a complicated area. So what's the biggest misconception that a lot of people have about investing?
Yeah, I think one of the biggest misconceptions is really that activity sort of equals results, that the more trading, the better. People's instincts, especially when markets are moving around and there's a lot of news flow and things, is often to make more trades, to change portfolios, to tinker, because it feels productive. But I think in practice, too much trading typically harms returns over the long term. There's a risk you sort of keep chasing your tail. Warren Buffett once called the stock market a device for transferring money from the impatient to the patient, and which I quite like. And so, we're always working, we're always striving to have the best views, the best portfolios, the best performance, but we put that time more into research and analysis rather than trading too actively.
So patience is quite an
Yes.
important virtue to have in this world then.
Yes, absolutely.
With that in mind, how important is it then to have a clear investment philosophy before people start allocating capital?
Yeah, we think it's super important. If you don't have a clear philosophy and process, then really it's uncertain what you're looking for and when. And a major risk, if you don't have a well-defined approach, is that you change how you invest, sort of influenced by market dynamics, and often people do that, at the worst possible time. The sort of fear of missing out can lure people into changing how they do things. For instance, quite a few value investors sort of threw in the towel and ended up buying tech near the peak of the dot-com bubble, and only for that to sort of reverse against them shortly afterwards.
Yeah, and of course we've had the Magnificent Seven more recently as well.
Exactly.
And the markets do seem to have been very volatile recently. Is that something you would agree with, or is it just sort of part and parcel of the investment world?
I think they've been quite volatile. There's been obviously a lot of global sort of geopolitical news flow with the Trump admin, with the events in US, Iran, and previously Venezuela. We've got the big SpaceX IPO that we've just had. There's a lot going on, quite a lot of noise, but that's just a natural part of investing, and we try to not get sort of too distracted by some of this.
So with all that noise then, do you adapt your processes depending on what's going on, or do you follow quite a consistent framework?
We try and follow a very consistent framework. So we've got a clear philosophy. We believe independent thinking combined with sort of rigorous in-house research really provides a strong foundation for long-term value creation. So we are independent investors in how we think and how we position. We're active investors. We sort of do our own cooking. We don't like to hug the benchmark and sort of do the same as everything else. But we really believe in doing what we do in a very clear and repeatable manner, a very consistent way. So we believe in maintaining what we call our rhythms and disciplines, our key meetings, analysis, activities, etc., across the working week, across the month, across the quarter. So we've got dedicated workflows for equity research, for fixed income, for asset allocation, for looking at funds, for our key themes, for sustainability. And these all feed into our investment committee in a consistent way.
And would you say that range of assets is one of your USPs?
I think, the way we have our sort of dedicated groups looking at different aspects of the market and then looking to sort of cross-pollinate ideas across those groups. And those all feed into our investment committee. And, one of the other sort of slightly different things about how we invest perhaps is we sort of then combine top-down and bottom-up analysis. So as the CIO, a key aspect of my role is to sort of assimilate the macro and market backdrop with the team's high conviction views that are developed across those work groups and sort of fed in to then assimilating those to drive our investment strategy and our asset allocation.
On the subject of USPs, Jon, I know that the conscious capital philosophy sits very much at the heart of Capital's approach. So can you just explain a little bit more about what that is and how it comes out in the portfolios?
Yes, our conscious capital approach really guides our investing throughout our ranges. In terms of our core strategies, we're signatories to the UNPRI, the Principles for Responsible Investment. So this provides a framework to help us evaluate investments, steward capital responsibly, and balance opportunity with accountability. And then in our Better World strategies, we really emphasize that profitability and sustainability are not mutually exclusive. And commonly, increasingly, I think the most successful companies are those that are forward-looking, that are well-governed, and that use resources most efficiently. So this philosophy, this sort of ethos really guides us across everything we do.
And is there a strong appetite from investors for more sustainable investments?
Yes, I think there's an appetite for, at the more sustainable end for these strategies like our Better World range. But it's important to, emphasize that we offer strategies right across the board, and in our more core strategies, we still think we can invest in an ethical way, in a thoughtful way, without sacrificing returns at all.
Brilliant. And you mentioned cooking earlier. If you had to break it down, going with that analogy, what ingredients would you say are key to a strong portfolio, and where would something like diversification sit within that?
Yeah, well, we really do believe strongly in building diversified and sort of differentiated portfolios. Quite a few investors, quite a few firms follow perhaps a more traditional sort of stocks and bonds, traditional portfolio type approach. We do look to be more diversified. We tend to make more use of liquid alternatives and also real assets. So we tend to have a more diverse portfolio that we build, and we believe that serves us well in terms of being able to navigate different environments, not just being too sort of closely fitted to the very current environment. So within that, we look to really diversify our portfolios in different ways. Within our equity exposure, for instance, we'll look to ensure we've got a balance of growth, quality, and value exposure. We'll look at which parts of our portfolio are in favour versus which ones are perhaps a bit contrarian, or where we might be early to something we think's underappreciated. We always want a balance of the two, because while we want to have these differential views, it's also important that portfolios deliver when clients expect them to. When markets are doing well, we need to make sure we're participating. So we want that balance of sort of in favour and out of favour, perhaps, exposures. We'll combine both active and passive investment vehicles. We tend to emphasise predominantly active strategies and active funds that we allocate to as well, particularly where they've got a well-proven track record, where they're adding value, they're adding alpha, as we call it. But at the same time, we're pragmatic and we'll use passives where they can be very efficient, they're cost effective, they can be useful for sort of tactical positioning. So we'll combine all of those things in our portfolios. And while we want to be diversified, we don't want to sort of go to the extreme where people call it diversification when you get beyond a certain point. So we still want to be able to emphasize our high conviction themes, our high conviction views. So we make sure we're still sort of showcasing those in terms of portfolios enough to be able to move the dial with returns, but never to have too many eggs in one basket.
Yes. And does that
Turning back to cooking.
Does that diversification help then to withstand some of the volatility in the markets?
Yes, we believe so. I mean, the market can quite quickly shift from pricing in one kind of environment to another, one sort of market regime to another. Recently with the US-Iran conflict and the closure of the Hormuz Strait, there's been a lot of concerns again about inflation or even stagflation. So markets will sort of change their behaviour, and then as that situation's somewhat eased and we've got oil prices coming back down, the market regime will change again. So we want within our portfolios different holdings, different exposures that can do well in different regimes. We're not dependent all on one or another, and we think that helps to sort of navigate through the twists and turns a bit more smoothly.
Absolutely. And you mentioned earlier that knee-jerk reactions are not recommended. Are there any other mistakes that people tend to make or could be tempted to make when they see markets fluctuating so extremely?
Yes. Well, I think people tend to get caught up in very near-term market dynamics and also like looking at short-term returns. And there's then a temptation to, when things are really doing very well and the market's had a strong run, people are keen to then add risk. And then when things are, you're going through volatility in difficult periods, people make the mistake of then wanting to cut risk at the worst time. So I think it's always important to sort of take a step back, look at things over a longer horizon. Otherwise, you tend to you can get caught up doing the wrong thing at the wrong time. I mean, we've seen a lot of speculative excitement in markets recently. We've had the SpaceX IPO that a lot of retail investors have been excited to participate in. We've had a really strong run in parts of the AI sort of theme, which is there's good investments within that, but we're always trying to take a sort of balanced approach and not get caught up in the hype of the moment.
And I suppose in addition to your professional advice, that communication and relationship side is really important for reassuring clients and explaining to them what steps they should perhaps be taking.
Yes, we think that's really important to keep a close dialogue with investors. We write pretty full commentaries every quarter talking about how we're seeing things, what we're doing in portfolios, what investments we're making. We're touching base with clients and giving more communication when we go through volatile periods to reassure clients, because the last thing we want is people to sort of lose composure at the worst time, and they take their reduce their investments when we've been through a bad period in the market, increase them when we've already had a great run. We want people to have that time in the market rather than trying to time the market. So we're always trying to keep that communication to help people stay composed.
So patience, composure, diversification, they're some of the key words that have come out of this chat this morning. But if you were to give a 30-second elevator pitch, sort of summarising the messages that you would really want people to go away with from this, what would that message be?
Yeah, I think at the core of what we do is a very clear philosophy. We're independent thinkers, independent investors. We do rigorous research ourselves, and we build carefully constructed portfolios with ample diversification, but emphasizing our high conviction themes. So that we believe that's the best way to deliver strong and consistent returns over time. And that's really been coming through in good outcomes for our clients, in how we've helped them navigate through different market environments. So if anyone's reviewing their portfolios or just looking for a fresh perspective, we love to have a conversation. So don't hesitate to get in touch with us.
Brilliant. Well, Jon, thank you very much. Really interesting conversation.
Thanks,
you.
Emily.